What is capital gain? Capital gain refers to the increase in the value of a capital asset, realized when the owner sells the asset. It can be classified as short-term if the asset is held for less than a year or long-term if held for over a year, and it must be reported on income taxes. While capital gains are often associated with stocks and funds due to their liquidity, they can also be calculated on any security purchased for less than its selling price. Upon selling an asset, realized capital gains or losses are recognized, triggering a taxable event. In contrast, unrealized gains or losses, referred to as papered gains or losses, reflect the investment's value without triggering a tax obligation. The tax treatment of capital gains and losses varies by the holding period. Short-term capital gains are typically taxed as ordinary income, while long-term capital gains usually face lower tax rates. When an asset such as property, a car, a business, or shares is sold after a period of ownership, capital gain occurs when the selling price exceeds the purchase price, leading to a capital loss if the purchase price is higher. Capital gains are generally subject to taxation, with rates and exemptions differing between countries. Calculating capital gains typically involves subtracting the asset's base cost from its selling price. For long-term assets, incurred expenses are also considered, resulting in either a gain or a loss if the value is negative. The full value consideration is the amount received by the seller, while the cost of acquisition represents the asset's value when acquired. The indexed cost of acquisition adjusts for inflation using the Cost Inflation Index (CII), reflecting changes in price over the years the asset was held. In Australia, the Australian Taxation Office (ATO) defines three methods for calculating capital gains: the discounted method, where super funds and eligible individuals may reduce their capital gain value; the indexation method, which allows for an increase in the asset's base cost using an index factor; and the general method, which considers the difference between the selling price and the base cost. When a capital asset is sold, capital gain or loss is calculated based on the difference between the purchase and selling prices. Both scenarios must be reported in the income tax return. Although referred to as capital gains tax (CGT), it is not a separate tax but part of the income tax. A capital gain adds to assessable income, potentially increasing tax liability, while a capital loss cannot offset other income but can reduce future capital gains. In terms of measuring CGT on rental properties, it is crucial to understand how CGT is assessed, as tax is only payable in the financial year the property is sold or disposed of. Employing experts, particularly a qualified tax accountant, is essential when determining CGT. There are three methods for calculating capital gains in property transactions in Australia. The CGT discount method allows a 50% reduction in capital gains for individuals and a 33.3% reduction for super funds for assets held for a year or more. The indexation method allows for raising the cost base using an indexation factor based on the Consumer Price Index (CPI) for properties purchased before September 1999. The third method applies to assets held for less than a year, where the cost base is subtracted from the capital proceeds, excluding the days of purchase and the CGT event.